Okay, so here is a genuinely weird one. UnitedHealth Group basically just told Wall Street that 75% of their health insurance earnings are going to be, well, completely finished by July.
Yeah, just take the second half of the year off, I guess.
Exactly. Welcome to Earnings Unscripted, where we try to make sense of things like that. Today is April 21, 2026, and we are looking at UnitedHealth's Q1 2026 numbers, ticker UNH. And just to give everyone a quick baseline, they brought in $111.7 billion in revenue. That is actually down a tiny bit, roughly 1.3% from last quarter.
Right, but the operating income went the complete opposite direction.
Up to $9 billion, which is a huge jump. Adjusted EPS came in at $7.23. So, Miro, strong numbers. The stock gapped up over 6% before the bell and basically held on to most of those gains to close around $3.46. What is your actual read here?
Look, the market clearly loved the bottom line, and that net margin hitting 5.6% is solid. But the top-line revenue isn't the real story today. It is the medical care ratio, the MCR, and just the really aggressive way management is trying to protect it right now.
Right, which we definitely need to unpack. Actually, sorry, really quick before we do, standard reminder that this is just two friends talking markets. So, no financial advice here, just our personal opinions. Please do not sue us. Okay, so you mentioned the medical care ratio.
Right. So MCR came in at 83.9%, which is quite good for them historically. But to achieve that, Optum is deliberately actively shedding over 1 million Medicare Advantage members this year, around 1.3 million in total.
That is just wild to me. For a massive U.S. health insurance provider, walking away from over 1 million customers sounds, highly counterintuitive on paper.
It is, but it's also the ultimate flex of pricing discipline. They basically realized that holding onto those specific accounts is just burning cash. It's simply better to shrink the top line to save your margins.
It feels kind of brutal when you think about it in human terms, right? Like, yeah, your healthcare is just too expensive for our model, so we're good. Although they did balance that out slightly on the karma scale. I saw they're accelerating payments to a lot of independent rural hospitals right now.
Yeah, by 50%. Which is an incredible use of their balance sheet. They're acting almost like a bridge financier, keeping the rural healthcare supply chain from literally collapsing. And they can afford to do it because they generated almost $9 billion in operating cash flow this quarter alone.
Wow. Okay. So massive cash generation, intentionally shedding unprofitable members, and this totally bizarre front-loaded earnings calendar. I feel like there are a lot of hidden gears turning under the hood this quarter.
There are, especially if you look at how they actually got that medical care ratio so low. There's some, let's call it creative accounting happening there that Wall Street is kind of ignoring.
All right, let's get into the details on that. I definitely want to hear how they're making those margins look so pretty.
Right. So you look at that 83.9% MCR and it seems fantastic. But if you dig into the 8K carefully, they actually got a 20 basis point direct benefit from a reserve release.
Wait, a reserve from when?
Literally last quarter. In Q4, they set up this provision for third-party loss contracts. They basically set aside a big chunk of money for contracts they fully expected to bleed cash.
Okay, and now they just took it back.
Some of it, yes, which mechanically lowers the medical cost ratio today. It is completely legal, but it means the current margin is being heavily subsidized by a kitchen sink write-off they took 3 months ago.
Wow, so they just move the money between buckets to protect the optics?
Pretty much. And then there is a really bizarre anomaly buried in the operating costs. They took a $900 million hit for incentive compensation. $900 million. For context, they only paid out $35 million for the exact same line item last year.
Sorry, what? That is a casual 2,000% jump. Did they fire the entire executive team?
Actually, yes, they kind of did. Stephen Hemsley noted they refreshed nearly half of their top 100 leadership roles.
Half?
Okay, that is a massive internal culture shock. And at the exact same time, they're pulling squarely back to the U.S. market. I saw they finalized selling Optum UK, and they're actively dumping their South American assets too.
Right, but the UK sale is actually fascinating because they recorded a $525 million gain.
Which normally you would just drop right on the bottom line to make earnings pop.
Exactly. But Devoit pointed out they took $400 million of those net proceeds and immediately funded the UnitedHealth Foundation with it, specifically to support the healthcare workforce and behavioral health.
Which is, objectively speaking, an amazing thing to do. But financially, it is a very clever way to wash a one-time windfall off the books without permanently distorting their operating baseline. Wall Street cannot model a charity donation into next year's run rate.
It is a constructive wash. Look, they are running incredibly hot right now, tearing out management, shedding bad accounts, moving assets, which is why the operational efficiency side is basically their anchor right now. They are aggressively substituting labor with AI.
Right.
Wall Street is completely exhausted with companies promising AI returns by 2030, but UnitedHealth is investing nearly $1.5 billion on AI initiatives this year alone. They are getting real ROI today.
Yeah, and this is where it actually impacts normal people. I was looking at their pre-check platform. Patrick Conway gave a wild statistic on the call. He said, quote, "Our unique pre-check prior authorization capability reduces prescription approval time from over 8 hours to under 30 seconds."
Over 8 hours to 30 seconds?
30 seconds, which if you have ever waited at a pharmacy for your insurance to clear a specialty drug, that is just completely life-changing.
Right. And they pointed out it dropped claim appeals by 88%. That is a massive friction reduction. Then on the back end, they are using a platform called Optum Real to reduce manual contact costs by 76%. Look, this is not generative AI writing cute marketing emails. This is hardcore automation destroying the worst bottlenecks in the industry.
Mind blown. They're literally rewiring the company from the inside out while masking the construction noise with reserve releases.
That is actually a very accurate way to summarize a deeply complex 8K.
Well, I try. Okay, but if they are relying this heavily on first half accounting maneuvers and tech deployments just to stabilize the ship, where does that actually leave them heading into the back half of the year?
It leaves them entirely reliant on Optum because the insurance side, UnitedHealthcare, is, well, it is basically going to fall off a cliff after June. The CFO was incredibly explicit about this. Because of changes to Medicare Part D from the IRA, UHC is printing over 75% of its earnings in the first 6 months.
Wow. Okay, so the core insurance engine just goes into hibernation for the fall, and Optum has to carry the entire weight of the back half?
Yeah. Optum Insight and Optum Rx generate roughly 60% of their earnings in the second half. But, I mean, the execution pressure there is going to be immense. If Optum stumbles in October, there is absolutely no insurance buffer to hide the miss.
Right, which makes their full-year guidance actually makes it feel incredibly bold because they confidently raised the target anyway. They're projecting adjusted EPS of greater than $18.25. It feels like they are practically begging the market not to panic over the weird seasonality.
They are not just begging, they are buying. They pulled forward a massive share repurchase plan. DeVate, he literally said on the call, quote, "Based on our current share price and the deep intrinsic value discount at which our shares are currently trading, we will deploy at least $2 billion by the end of the second quarter."
At least $2 billion before July. Okay, so management genuinely believes everyone is mispricing this turnaround. They're putting serious cash behind that discount line.
Yeah, it is a very clear signal. Look, you step back and look at the whole playbook. They dump the unprofitable members, refresh half the executives, mask the margin pain with prior quarter accounting, and just buy their own stock aggressively before those AI efficiencies fully kick in. It is a high-wire act, but a highly calculated one.
Shrink to win. Let the algorithms handle the paperwork and just buy the dip on your own company. Honestly, if they pull this off, business schools will be teaching this 8K for years. All right, I think that perfectly brings us home. Thanks for cutting through the noise with me, Miro.
Anytime, Susie. See you next week.
Bye, everyone.
If you want these little teardowns to just naturally show up in your feed, go ahead and hit follow. Just a quick transparency note before we wrap. We do use AI to help sift through all those raw SEC filings before we sit down at the mics. If there is a specific ticker you want us to dig into next, just shoot an email over to earningsunscripted@datamadness.ca or hit that X link in the show notes. Catch you on the next call.
Take care, everyone.